In the world of stocks, Novo Nordisk is a true giant, dominating diabetes and obesity treatments with blockbuster drugs like Wegovy and Ozempic. The company has become a household name, not just in the pharmaceutical industry, but also among investors who crave growth and stability. Its innovative therapies have changed millions of lives, and its reputation for scientific excellence is second to none. For years its stock soared, making investors rich and cementing its reputation for growth and innovation. Novo Nordisk was the envy of Wall Street, a symbol of what happens when science and business align perfectly. Every earnings report seemed to bring more good news, and the company's market value ballooned. But Wall Street is ruthless. What goes up can come crashing down. No company, no matter how mighty, is immune to the market's harsh reality checks. On February 4, 2026, Novo Nordisk's stock plunged. Double digits, billions wiped out in hours. The news sent shockwaves through the financial world, leaving analysts scrambling to explain what had just happened. This wasn't a minor dip, it was a full-blown fire sale, triggered by the company's own forecast. Investors rushed to sell, desperate to avoid further losses as panic spread. Even the strongest champions can get knocked down. In the blink of an eye, years of steady gains can be erased by a single misstep or a shift in expectations. So, what happened? It all came down to the future. Investors are always looking ahead, trying to predict what's next, and sometimes the future looks a lot less rosy than the past. The market cares less about yesterday's profits and more about tomorrow's prospects. It's a game of anticipation, and sentiment can turn on a dime. Novo Nordisk's latest report had solid 2025 numbers, but the 2026 outlook was a shocker. Growth projections suddenly looked shaky, and the company's confidence seemed to waver. The company's guidance was a bucket of ice water on a red-hot stock, and investors bolted. The optimism that fueled the rally evaporated almost instantly. This isn't just about one brain and jury. It's about pricing power, competition, and how quickly sentiment can turn. Rivals are circling, and the market is unforgiving when growth slows. The Novo Nordisk saga is a textbook case of what happens when a growth story hits a wall. It's a reminder that no company can defy gravity forever. So let's break down what went wrong, and what it means for you. There are lessons here for every investor, whether you're a seasoned pro or just starting out. Grab your notebooks, classes in session. We're about to uncover the real story behind the headlines and see what you can learn from Novo Nordisk's dramatic fall. We'll dissect the fall of a market darling. Ready? Let's dive in. Booyah! The heart of Novo Nordisk's collapse, its 2026 sales forecast. Instead of growth, the company projected sales would shrink by 5% to 13%. For a growth juggernaut, this was a bombshell. Wall Street expected more growth, not a reversal. The guidance was about 8% below analyst expectations. A massive miss. Investors panicked. The stock plummeted 16% in Copenhagen, nearly 15% in New York. This wasn't a minor adjustment, it was a mass exodus. The shockwaves hit the entire healthcare sector. When a high flyer slams on the brakes, you have to ask, why? Is this a temporary setback or a sign of deeper trouble? The market's brutal reaction was pure fear. Sell first, ask questions later. But we're not panicking. We're digging in. Let's find out what's really spooking investors. The main culprit? U.S. pricing pressure. For years, the American market has been the engine of pharmaceutical profits, but now, that engine is sputtering. Novo Nordisk pointed to lower prices from the most favored nations agreement, forcing them to cut prices on their bestsellers. This policy aims to align U.S. drug prices with those in other developed countries, squeezing margins for companies used to charging more. Lower prices mean less revenue, even if sales volume holds. The bottom line shrinks, and that's a tough pill to swallow for any business. Imagine running a pizza shop. If you're forced to charge less per pie, your profits drop unless you sell a lot more. But in pharma, you can't just double your customers overnight. That's Novo Nordisk's dilemma. They're caught between regulatory demands and the need to keep shareholders happy. The US has been their cash cow, funding growth and research. Profits from American sales have powered innovation and expansion for years. Now, with drug pricing under fire, those fat margins are shrinking. The pressure is on to adapt or risk falling behind. Even new products like an oral Wegovy pill can't fully offset the hit from lower injectable prices. The pipeline is strong, but the math just doesn't add up fast enough. Analyst Evan David Seigerman summed it up: gains from new pills are being wiped out by losses on injectables. The company is running to stand still. It's like filling a bathtub with the drain open. No matter how much you pour in, it keeps slipping away. The market fears the days of easy money in the US are ending. Investors are bracing for a new era of uncertainty and volatility. Novo Nordisk faces a new reality: tougher pricing, tighter margins, and a future that's far less predictable than before. Investors are right to worry. The landscape has changed, and the path forward is anything but clear. Next up, the patent cliff, a moment every pharmaceutical giant dreads. Patents are the lifeblood of pharma profits, granting companies exclusive rights to sell their blockbuster drugs, but these protections don't last forever. They have a ticking clock. For Novo Nordisk, the patent for its star drug, semaglutide, is nearing expiration in several key international markets, opening the door to new threats. When generics enter, prices nosedive and profits can evaporate almost overnight, leaving companies scrambling to adapt. While the US patent remains intact for now, international markets are already feeling the sting of lost exclusivity and shrinking margins. The era of monopoly pricing is ending, and the market is bracing for a wave of revenue declines and tough decisions. But the challenge isn't just from generics. Competition from other big players is intensifying at a rapid pace. Major pharmaceutical rivals, especially Eli Lilly, are aggressively launching their own obesity and diabetes treatments, aiming to capture market share. The field is getting crowded, fast, with new entrants and alternative therapies flooding the market. More competition means relentless price pressure and a fierce battle for every single prescription written. Novo Nordisk can no longer rest on its laurels. It must fight harder than ever to defend its market share and reputation. The easy days of dominance are over, replaced by uncertainty and the need for constant vigilance. The company's cautious 2026 outlook is a clear reflection of this new, tougher landscape, where nothing can be taken for granted. The big leagues just got a lot more crowded, and the stakes have never been higher. Now, survival depends on out-innovating, outmaneuvering, and outcompeting every rival in a rapidly evolving industry. To see why investors panicked, compare 2025's triumph to 2026's warning. In 2025, Novo Nordisk posted 10% sales growth, stellar for a company its size. US sales rose 8%, international sales 14%. The company looked unstoppable. Then came the 2026 forecast, a 5% to 13% decline. That's not a slowdown, it's a U-turn. The narrative flipped overnight from relentless growth to looming decline. The market hates negative surprises, and this was a shocker. Analysts scrambled to rework their models. The party, it seemed, was suddenly over. In the stock market, no company stands alone. Novo Nordisk's bad news didn't just hurt itself, it dragged down rival Eli Lilly too. Lilly's stock dropped nearly 4% the same day. Why? Investors feared Lilly would face the same pricing and competition headwinds. Problems at Novo signaled industry-wide trouble. The market shot first, asked questions later, and repriced the whole sector. Even without its own bad news, Lilly was guilty by association. When you invest in a company, you're also betting on its industry's fortunes. As if things weren't chaotic enough, Novo Nordisk announced a leadership shakeup. Dave Moore, head of U.S. operations, stepped down for personal reasons, right as the company faced its biggest crisis. The timing raised eyebrows. Was it really unrelated? Investors crave stability, especially in tough times. Jamie Miller was quickly named as the new U.S. chief. He inherits a storm pricing battles, fierce competition, and a shaken investor base. His every move will be scrutinized. Leadership transitions can bring fresh ideas, but also disruption. For Novo Nordisk, a smooth handover is critical. The market wants reassurance that the U.S. team can steady the ship. To understand Novo Nordisk's plunge, you need to grasp market psychology. Stocks trade on emotion as much as numbers. When a high flyer like Novo Nordisk stumbles, fear takes over. The stock was priced for perfection. Any flaw triggers panic selling. It's a vicious cycle. Fear leads to selling, which leads to more fear. History repeats. Think Meta in 2018 or Netflix when growth slowed. Both were punished for missing sky-high expectations. Novo Nordisk's 2026 forecast popped the bubble. The market's reaction wasn't just rational, it was emotional. When a growth story ends, the stock gets re-rated. That's what happened in one brutal trading day. The lesson expectations can be as dangerous as reality. After the dust settles, what's next for Novo Nordisk? First, all eyes are on execution. Can they manage U.S. pricing pressure and stabilize margins? New U.S. leadership must prove itself fast. Second, the pipeline investors want to see new blockbuster drugs in development. The patent on semaglutide won't last forever. Third, competition. Can Novo Nordisk defend its turf against Eli Lilly and new rivals? The oral Wegovy pill's launch will be closely watched. Finally, management must set realistic expectations and rebuild trust. The era of effortless growth is over. Now it's about resilience and adaptation. Don't count them out, but don't expect a quick comeback either.